This is the Better System Trader Podcast, Episode 5.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, welcome to the Better System Trader Podcast, episode number 5. Today's guest has been developing, analysing, testing and creating trading strategies for over 25 years in every futures market from the E-mini S&P to crude oil to corn to cocoa. In the years 2005 to 2007 he entered the World Cup Trading Championship, placing second in 2005 and 2007 and coming first in 2006 with more than 100% return each year. He now trades full-time for his own personal account and coaches small groups of traders to significantly improve their trading. He's also written a book on building algorithmic trading systems and has been featured in other books and magazines. In our chat today, he talks about how he went about winning the trading competition, the types of systems you want for the future, some very important aspects of system development that will cost you money if you ignore them, what you need to do before you start trading a strategy, and what skills you need to be a good system developer. He offers some really valuable insights and provides an excellent process to system development. So let's get to it. Don't forget to continue listening after the interview is finished to find out about the session bonus, my top 5 tips from this episode, and a sneak peek at the next episode. The guest for today is Kevin Davey. I hope you enjoy it. Thanks for joining us today, Kevin. I appreciate it.
Oh, no problem, Andrew.
So I think I'd like to start off with a bit of your background because I think you have a really interesting story about how you got started in trading and where the journey took you. So could you please share some of that with us?
Sure. I started really from getting a piece in the mail that was a direct mail piece that talked about how great it was to trade in commodities and how much money you could make. And although the course associated with that didn't work out for me, from that point on I was kind of hooked. And from that point I kind of did a lot of part-time trading for a number of years, and like most people went through all sorts of different types of systems and approaches, and doing things like trading a certain way and then that was losing, so then I immediately flipped to the trading the opposite way, and also trading where I'd put on enough contracts that if I lost money I'd have to meet a margin call. So I used to run to the bank when I had a full-time job. I used to run to the bank at lunch and deposit money, wire money to my brokerage so I wouldn't have to face a margin call. A lot of basically a lot of silly things I did over the years. And as time went on, I started to get a lot smarter about it. And since I had an engineering background, I looked at it more from a numbers point of view of what could be done test-wise to prove out certain ideas. And so I got a lot more involved in testing ideas and doing historical testing to verify it. And of course, when I started out doing that, it was pretty much the same end result because I was testing incorrectly. I didn't know how to develop a trading system, and I was over-optimizing and too many variables and using too little market data and things like that. So it took me a while to really understand the whole process. And then a while back, I was able to actually come up with a system that I traded in a worldwide trading contest, which was a year long with real money. And 3 years in a row, I was able to finish over 100% return each of the years. And so 2 of the years I finished in second place, and 1 of the years I was able to finish in first place. So that kind of gave me quite a bit of confidence that I could actually trade, because here I was able 3 years in a row to have over 100% returns. And then the way it worked out, I was working full time. I was in the aerospace field and trading part time. And the way it worked out, our company got bought out by a big company, and I basically had an opportunity where I could leave and still have a bunch of money saved up so I could go and trade full time. And ever since that point, about 7 years or so, I've been trading full time and developing systems and helping out some other traders now and then, but primarily just trading for my own account.
Wow, so that's a really inspiring story to hear your struggles initially. You faced some very common issues that beginning traders face, but you kept at it and you ended up winning the World Cup Trading Championship. So that's really impressive.
Oh, thanks. Yeah, it's I like it because I was able to finally make the leap. Everybody who's trading, especially on a part-time basis, is always hoping that eventually they'll be able to make that leap to full-time trading. I think there was a book written about it called "Live the Dream" or something like that, and I was lucky enough to actually get to that point where I can do it full time. So that's the great part when you start doing something you really love and you're able to do it full time and survive with it.
That's great. So it sounded like you really kind of turned things around when you started building some of these algorithmic systems yourself and figuring out ways to do proper testing and things. You've actually released a fantastic book called Building Winning Algorithmic Trading Systems, which I've read and I thoroughly love. I'd like to just chat to you for a little while about the strategy development process that you follow
Sure.
and some of the ideas that you've got in that book.
Okay.
So in the book, you discuss the role of goals and objectives being the start of the process. Why do you think this is important?
A lot of times, people will go into trading with, kind of dollar signs in their eyes, where they'll say, "Well, hey, I want to become rich. I want to make a lot of money," and a lot of that is just perpetuated by the industry itself, by certain factions of it, I should say, where they encourage people to trade on, with just a small account and be leveraged to the hilt and that kind of thing. And so people think, hey, I can make 1,000% return. And, they focus on the money making part of it without realizing that there's also a downside, which is, the inevitable drawdowns. So what I found is the people who go into these kind of ideas of trading where they're just expecting huge returns. They're just being unrealistic. And so that's why, to me, goals and objectives are so important. And they've got to be realistic goals. If you aim for 1,000% return every year, when you don't hit it, what you end up doing is you end up cheating and cutting corners. And, maybe if you're running a back test, you'll optimize it a little bit more to get better performance, which turns out that doesn't even really matter for real-time performance. It's just a way to make your back test look better. So, and then the people who don't have unrealistic goals, a lot of them have no goals at all. They just say, well, hey, I'm just going to start trading. And what I found is having goals and objectives is really key. And the first time I ever really used that was when I was looking at doing this trading contest. So I said, well, I want a reasonable chance of winning this contest. And so I went back and looked at all the previous winners in the percentage returns they'd have every year. And my conclusion was, well, if I design a system that has a good chance of 100% return in a year, I should be able to finish in the top three, and maybe I'll win it. So with that goal in mind, I was able to develop a trading system. And the nice thing about it was when I was done, I could compare it to the goal and say, yes, I met the goal, or no, I didn't. And once I thought I had met the goal, I could actually trade this system. And that worked out pretty well for me. So that kind of convinced me that having goals and objectives is really a key, because it really makes you think about what you want to do in trading, what you want to accomplish, and also how you're going to get there, meaning how much drawdown along the way. And then you start to look at things besides profit, like risk of ruin. How much capital do I need, even if I have a good trading system, to not get wiped out by some string of bad events? So the goals and objectives really becomes kind of like the cornerstone for everything else. And if you don't have that, it's kind of like building a house on sand, with no foundation. Eventually you could build the house, but eventually something's going to happen and it's just going to kind of fall apart because it's built on sand.
Well, that's very interesting because I think a lot of people they just start developing systems without really thinking of their objectives other than to make money. So it's quite interesting to hear you say that there's more to objectives than just that. So it's a good thing to consider. So once you've established your goals or objectives, what factors do you need to consider to start developing a system?
Well, yeah, once you have your goals and objectives, you'll probably know what kind of return you're looking for and what kind of drawdown. Then the big thing becomes finding an instrument or, picking an instrument. If you're looking at futures, maybe you want to look at something like gold or crude oil or, you can really pretty much pick any one and then you just go on and develop a trading idea and test it out and see what happens. Now, eventually over time, if you create enough strategies, then you might get pretty particular in what you're looking for. But, in the beginning, it's kind of wide open. You can look at just about any kind of instrument and apply your trading idea to it and see what happens. And what you'll see is some markets seem to be more friendly to traders than others. And depending on what kind of trading you want to do, if you want to do swing trading or intraday trading, that'll kind of lead you down a different path with a different instrument too.
Right, so there are, I guess, two different ideas for selecting a market to trade. You could either create a strategy that works on multiple instruments or one for a single instrument. What's your perspective on the advantages or disadvantages of each of these?
Well, I've actually done both. So back when I was trading the contest account, actually created a system. It was a trend following system that I applied to 8 to 12 different markets. And so it was basically the same system, just with different parameters. So at one time, that's kind of how I did things. Now I kind of do things differently where what I'll do is I'll actually create a system for a particular market. And then if it happens to work, I might actually try to apply it to different markets, but I don't have any particular requirement that says, well, you developed a system for the ES, so therefore it has to work on the TF, the mini Russell, the mini NASDAQ, the mini Dow. Some people have those kind of requirements. I don't. Obviously, it would be nice if I took a system and I found it worked on other markets, but what I found is a lot of times the markets are so much different. So even the ES and the TF, for example, they're both stock market indices. They're both pretty correlated, but they both have different characteristics that can be exploited, and what works on one might not work on the other. So I've kind of where I'm at now is looking more at market-specific systems, but at the same time, if I find one that works on multiple markets, I certainly would use it.
Right, excellent. Thanks, Kevin. So we've established some goals and objectives. We've chosen a market. We've got some trading ideas. What's the next step in the process?
Well, the next step that I always use is just to run some simple tests just to see what I call if feasibility, if the system is feasible. So let's just say you had a simple entry. You don't even have to use your final exits, for example. You could use just a simple stop loss. And what you want to do is you want to get an idea that, or a sense that what you came up with actually might work going forward. And the key to that, I think, is not to test over your whole data set. Because once you start testing over your whole data, all your market data, you start to run into the trap of optimizing and curve fitting and trying to add rules to fit that data. So what I normally do is I usually take a 1 to 2 year piece of that market data. So let's say I want to run my test on 10 years of data. I'll take 1 to 2 years and test out my idea and do maybe a little optimization and a little rule changing and that kind of stuff to see if I can get my idea, if it actually works on that data. And if it does, then I'm prepared to kind of go on to the next step. If it doesn't, it means one of two things. Either the idea isn't very good, or maybe the idea just isn't very good during those 1 to 2 year period. And so I end up, without knowing which one's which, I probably end up throwing away some good ideas along the way when they don't work over a 2 year period. But by and large, the ideas I toss out probably wouldn't work on all the, if you used all 10 years of data. So this is it's kind of like a pre-screening tool to kind of just eliminate the bad ideas. Because frankly, most ideas that you'd come up with or that you see even in books and magazines and find on the internet, most ideas as is probably don't work over the long haul. But they might be a good starting point for your own research. But in the end, I throw away a lot more ideas than I actually accept.
So there are a number of elements that combine to form a trading system, like entries, exits, market selection, time frame, etc. So changing just one of these can have a huge impact on the results. How do you test a system with so many variables?
Well, normally what I would do is I'll have a market in mind. So we kind of fix that. So let's just say I want to develop a system for gold, just for example. And then I usually have a sense of what kind of time frame I'm looking at, and if I want it to be like an intraday system or a swing trading system. So I might have a couple bar sizes in mind. So maybe I'll do like 60-minute bars and 240-minute bars and daily bars. So maybe I'll test out my idea over those particular bars. I don't want to do every single possible bar minute by minute to test them all, because then eventually you're going to find something. But I try to just do some general 60, 240 daily, see what happens. And then I'll look at a couple variations of an entry. A lot of times I'll already have some kind of entry idea. So let's just say some kind of breakout system. Okay. Well, I might just apply a simple stop loss to it just to see, hey, does that breakout system work? And then I might also put an exit after X number of bars. And then I can look at the results and say, okay, well, this entry, seems to be valid or seems to give some kind of edge for maybe 5 or 6 bars or something like that. But after that, maybe it falls off. So just looking at that on some limited testing, I can kind of come up with a good idea for an exit possibly, and also kind of refine the entry. And, by the time I get to the next step, which is more detailed testing, I've pretty much have my system and I know what time frame I'm looking at.
So when you're testing all these systems, what metrics are you using to judge the performance results?
Well, it really depends what I am looking for. So let's just say I'm testing an entry, and I just want to know that an entry is valid. There's a couple different ways to look at an entry. One, if you subtract out all the costs and everything, obviously you want an entry that's more accurate than 50%, because 50% would just be a random entry that you could just throw a dart at a wall and a dartboard and just randomly pick numbers. You want something that's more than 50%. So if I'm looking just at winning percentage, depending on the number of trades, usually 55, 60%. If I can get that over a significant number of trades, then maybe my entry gets me going in the right direction. The other side to that is, well, maybe you don't care about how often you're right, but when you're right, you want to be really right. So, meaning you want to get signals, there'll be a lot of false signals, but the good signals will make up for all those false ones. So, in that case, what I would do is I'd actually test with slippage and commission added in. And if I'm doing some iterations on this limited data, what I generally look for is around 70% of the cases to be profitable. So what I mean by that, let's just say I took a breakout entry and I ran it from 10 to 50 bars of a breakout in increments of 5. So I have, let's say, 10 or 11 cases. I would want probably 7 or 8 of those to show some profit after expenses, because that will show me that, one, the entry is robust. It kind of works over a wide range of inputs. And two, it gives me a good sense that there actually might be something to that entry. But the flip side is, let's say I run that test and everything I try is negative, or most of the cases are negative, they give negative profit. That would probably indicate that that particular entry just wasn't that good. And so I'd have to go back to the drawing board with it.
So a little bit further on this testing, in your book you mentioned something called the monkey test.
Yes.
Can you tell us a little bit about that?
Well, the monkey test comes from, there was a book way back when, I think, where somebody tried to have monkeys pick out stocks to buy, and their conclusion was the monkeys can do pretty good sometimes. And, but the monkey doesn't know what's going on, so it's just a random test. So sometimes what I'll do is I'll actually run tests with entries or tests with exits with randomness to it. So for example, I might run a breakout test for an entry, but for the exit, I'm going to randomly exit after a certain number of bars. And that helps you get some statistics of just how accurate or how valid that entry might be. And then the flip side, you can also do that with your entries where you randomly enter the market and you can actually test out exits. So sometimes I use those techniques to kind of get a better sense of, hey, does this exit have any merit? Does this entry have any merit? And it kind of eliminates a lot of things, because if you can kind of show some success with some randomness in there, it gives you just a little bit better idea that maybe you have something there to work with.
Yeah, that's a very interesting technique to validate certain components of a strategy. So thanks for sharing that. In the book, Universal Principles of Successful Trading, you were quoted as saying, "For me, being a successful trader means employing the principle of Occam's razor."
Yes.
Can you explain what that is and how it applies to trading?
Well, William of Ockham was, I think, a 13th or 14th century monk. And he came up with this principle that when you have a choice between a simple answer and a complicated answer, the simple answer is usually better. And that's the principle of Occam's razor. So, for instance, anyone with kids probably can relate to this, where, let's say, a glass, you come into the kitchen, there's a glass broken on the floor. Okay, well, you ask your children, how did this happen? And if they come up with a convolute, and you think they did it, okay, so the simple answer is they accidentally dropped a glass. But let's just say you ask them and they say, well, we were going for a glass and then a dog ran in the house and scared us, and then it jumped up on the counter and knocked the glass over, and then it tipped and then fell and rolled on the ground, and then it broke. That's a complicated answer. So which one do you think's right? Well, it's probably the simple answer. So all things being equal, the simple answer is usually the right answer or the best answer. And I use that in trading all the time, because you can come up with a system that looks great, tests great, that has 100 variables, and dozens and dozens of rules. But you can also come up with a decent looking trading system that has one rule and maybe one variable. And all things being equal, what do you think? Which one do you think is probably going to work better going forward? Well, a lot of people would think of the more complicated one, but the reality is the simpler systems tend to adapt better to future conditions because you're not imposing so many rules and filters and that kind of stuff on the system. You're just letting the system run and run with simple rules. And that tends to work, from what I found, tends to work a lot better. So that whole principle of Occam's razor, go for the simplest solution possible. That's really my whole strategy development comes down to that, trying to make the strategies as simple as possible and not overly complicate them.
Oh, thanks. That's some great advice there. Keep it simple. So once we have a trading system that's passed all of our preliminary tests, what do we do next?
Well, my next step is now you want to go to the in-depth testing. And, there's a lot of different ways to do it. I use what's called walk-forward testing. It's a type of out-of-sample testing where you end up with a lot of results that weren't optimized on the data that it's evaluated over. It's basically how walk-forward works. What you don't want to do is evaluate your system and optimize it completely and then look at the results and take those results and think you're going to actually trade with that, because of course your results are going to look good because they're optimized and you're showing optimized results. That's not what the real world is going to be like. So you want to do, in my opinion, you want to do some sort of out of sample testing where you evaluate it and you change parameters, but you evaluate the system on different data than what you tested on. So that point becomes probably the key testing point in developing a system. So you've already gotten through your preliminary testing and you said, well, maybe I have something. Now you do this in-depth testing and you do it over all the data. And the trick here is if it doesn't work and it's really bad, you probably just want to abandon the idea and just move on to the next one. What you don't want to do is go back and do a lot of modifications to your system and test again and run the walk forward or out of sample again and then do it again and again. Because what ends up happening if you keep doing that, eventually your out of sample, quote unquote, out of sample data becomes in sample data because you've tested with it so many times. So you want to really just test it once. Sometimes I do 2 or 3 times with just like minor tweaks to the system rules. But the way I look at it is you want to touch the data. You want to treat it as kind of like a historical document. And you've probably all seen pictures of people wearing the white gloves, and they pick up this real old document. They're not eating a cheeseburger or something and have grease all over their hands, and then they pick up this old document and kind of crumble it up and stuff. They don't do that. They treat it as if it was precious. And I think a lot of people would be better served by treating their data, their market data, like that. And that means you don't test something over and over on the same data. You don't want to torture your data, so to speak. You want to treat it with kind of white gloves. And when you do that, what ends up happening is you can believe the results you get, the out of sample results, a lot better because you'll know that you didn't over optimize and that you didn't just do some kind of data snooping or data bias or something like that.
Right, so if you're using walk forward optimization during this step, does that mean you should also re-optimize your strategies periodically during live trading?
Yes. So the way I do it is, let's just say I do this walk forward testing, and obviously we don't have time to get into walk forward testing today, but basically what it does is if you test over, let's say, a 4-year period and run your optimization, you might then use those parameters for, let's say, a year. So what it means is in real time, every year, you'll want to re-optimize uh, your data, but with your data with the last 4 years. So the approach I do is whatever I test, if I use a 1 year window where I'm reevaluating every year, then when I go live, I do the same thing. So if I was to show you my list of strategies, I've also got a list of when the next time I'm going to be optimizing or re-optimizing that system. So I know that well in advance. So I don't, I don't go and just optimize because the performance is down. No, I just stick to the set schedule that I have when I created the system.
And are there any cases where you wouldn't use walk forward analysis?
I have a few systems where I don't. Obviously, if you don't have any parameters to optimize, that would be a good example of one. Um, Other ones are some systems where it's just really hard to test them. So, for example, I trade some option strategies, and to actually backtest and evaluate option strategies is nearly impossible. So, those I don't use any type of walk forward testing. And then, as it turns out, sometimes I use walk forward testing, and the parameters, even though I'm allowing them to change, don't change. So, in effect, uh, I don't even really need the walk forward testing because the parameters just stay the same throughout their history. So, there's a couple of instances where walk forward testing really won't change things too much for you.
That's interesting. Thanks. So now that we have a strategy that's produced some walk forward results that we're happy with, where do we go from there?
Well, at that point, I like to do some simulation, some Monte Carlo simulation, which is all Monte Carlo simulation is really a way to uh, put some randomness in your test results and do some stress testing. And the reason you do that is when you do your walk forward optimization, you'll end up with an equity curve of, hey, had I been trading this system over the past 5 years, 10 years, here's what the equity curve would have looked like. Here's what profit I would have had. Here's the drawdown. But the problem is that's just the history. You don't know that's going to be what happens going forward. And in fact, things like drawdown, the old saying is your worst drawdown's always in front of you, meaning just because you had an historical drawdown of, say, $5,000 per contract doesn't mean that's going to be your future. It's probably more likely that you might have a 7,000 or 10,000 drawdown sometime in the future. So what Monte Carlo testing allows you to do is to basically scramble up the trades, and depending how the trades are ordered, you can get some of those worst cases. And so I like to evaluate that just to see, well, what happens if a lot of my losing trades all showed up right in a row? What kind of drawdown do I get? And that type of thing. So it allows you to kind of get some probabilities of what kind of drawdown you're likely to experience, what kind of profits you're likely to experience, what kind of chance, if you're trading with a smaller account, that you could get wiped out. Uh, I do that type of analysis to give me an idea of how robust the system is as far as, you're assuming you're still trading the same trades that showed up in history just in a different order. But what does that do? So I've actually found cases where the walk forward equity curve looked great. You probably, a lot of people would just make the decision, hey, I'm going to trade it. But when I'd run the Monte Carlo simulation, I found out that there was really a lot more risk in the system, and it was a lot riskier than I had anticipated. So basically, the amount of return that I was getting compared to the amount of risk I could have, that didn't necessarily show up in that historical equity curve, but the amount of risk I could have was just too much. for the profit I was getting. And so I basically said, well, I can't trade this particular system.
So how many runs should you make in a Monte Carlo simulation to get an accurate picture of how the strategy may perform?
Well, I normally do around 5,000, and that gives me fairly stable results. So I run 5,000 simulations of a year's worth of trading. So let's just say your system has 20 trades in a year. So I'll run that, get the results. You get an equity and a drawdown, and so that's case iteration one. Then you go back, start all over, run it again, run through your 20 trades. You get a second set of results. That's case two, and so on. And then you go through until you have 5,000, and then you just analyze the statistics. What was your median drawdown? What was your median rate of return? What was your chance of getting wiped out? The account getting wiped out. Those are the kind of things I look at. And 5,000 seems to be, at least all the systems I've dealt with, seems to be a good number where, there's still obviously some variation if I'd run the 5,000 today compared to tomorrow, but in general, you'll get pretty close to the same results.
Right. And in the Monte Carlo testing, what position sizing are you using for that?
I normally do just one contract, so I don't try to add in position sizing. What I'll do is later on when I go to add this system to my portfolio, or add it to something new, a new portfolio, that's when I'll look at position sizing. But I normally just test with one contract. And so I don't necessarily try to develop systems with position sizing in mind. And that's a lot different than some other really good traders I know, because they'll look at more at position sizing and how that impacts things. And the reason they do that is they might be trading fewer systems. I'm looking to trade a lot more systems, uh, and maybe even with smaller size. That doesn't bother me because I like the diversification of trading multiple systems.
Right. Okay. Thank you. So moving on from Monte Carlo testing. So up to this point, we've established our goals and objectives, developed a trading idea for our strategy, and performed some limited testing. We're happy with the results. We then conducted some in-depth testing using walk-forward analysis if possible, and we've completed some Monte Carlo testing to determine probabilities of strategy performance. Can we now trade the system?
You could, but I don't recommend it. And the reason I say that is because there's a few reasons. Well, one, how many times have you taken the system and tested it and thought you've done everything right and it looks great, and then the next day you start trading it, and of course, right when you start trading it, you go into a drawdown, and then a week later you're still in a drawdown, you get kind of depressed, and then you just turn the system off. Um, a lot of us have done that. I know I certainly have. So that's part of it. And the other issue is once you finish development, you get through these steps. They're not easy to get through, and so you have a certain feeling of attachment to this particular system because here you've been working with the system for a little while, and it's made it through all these steps, and so you're kind of emotionally attached to it. It sounds kind of strange to say that, but you are hopeful, obviously, that it's going to make you money, and so you want it to succeed. And what I find is when you start trading a system like that, where you have this attachment to it, when things go wrong, or if things go good, you're liable to make some bad decisions because of this attachment. So, for example, let's say it starts out doing good, you might be overly aggressive in adding on size because you're like, oh, this is the system I've been waiting 10 years to create. This is great. So you might be too overconfident. The flip side is maybe you hit a drawdown and you're attached to it, and instead of, all the numbers scream stop trading it, you're attached to the system because you've spent time working on it. You want it to succeed, so you let it go. And sure enough, it keeps going down, and it, ruins your account. So what I do instead of testing, trading it immediately after the testing's done, I put it aside. And I'll put it aside for a number of months, let's just say 6 months to 12 months. And all I do is then once a month, I go back and look at its performance and see how it's done. Now, obviously, part of that, if you're going to go back and look at the performance, that means you're going to be looking at a back test. So you've got to make sure your back test actually matches what would be real life trading. What do I mean by that? Well, if you develop a system and you don't include any slippage at all, if you assume that you're always going to buy at the bid and sell at the ask, you're not going to have realistic backtest results. And so even if you evaluate it running live every day, you're still going to have inaccurate results. So you got to make sure that what you've actually tested can be done in real time. So that's a key factor. And the first couple systems you develop, it's kind of tough to do, or kind of tough to know what to do. But once you do it and you see that, hey, my real-time results match my back test, then you'll have confidence. Okay, well, these are the kind of orders I have to use. This is the kind of slippage I have to use. So let's assume you already know all that. Then all you do is just monitor the system. I do it once a month. And then after about 6 months of operation, I take a look at what it's done in that period compared to what my walk forward test did. And if the results are comparable, then I'll consider trading it live. And so what this ends up doing, it takes away that emotional involvement, because now 6 months from now, you're not going to remember all the trials and tribulations of developing that system. So that emotional attachment isn't really going to be there. It's just a system, right? So that's good. And then the other thing too is if the performance goes bad right at the beginning, let's say you over optimized, or let's say you somehow were looking at peeking ahead at the data, and in real time, those kind of things will show up and your equity curve will suffer. So by just waiting a few months before you start live trading, you can eliminate quite a few of those bad systems. And you'll be left with systems that have shown themselves to work in real time, which is really nice.
So do you find many of your strategies actually fail this step?
At first, yes. As time goes on, less and less. But I actually recently did a study for some students I was working with, and I went back and looked at a group of 30 strategies that I developed over the past 5 years or so. And most of them were probably 3 to 5 years old. So most of them I developed a while ago. And I put certain criteria to say, here's what it's got to do after I developed it for me to trade it. And I found a couple interesting things. One, if I took all 30 systems and just traded them, I did fairly decently. I mean, they all, on taken as a whole group, they made a good bit of money. But there was also a pretty significant drawdown during, that live period. So then I went back and I put some criteria to that, 6 to 12 month test. And I said, well, here's the criteria this system has to make for me to trade it live. I went back. That eliminated probably about 10 or 11 of those 30 systems. So about a third of them. I just said, nope, based on this criteria, I'll never trade them. And what was interesting is the end result, the net profit at the end of this, I think it was like a 5-year test. The net profit was about the same, but my drawdown went down by about half. And I was also trading a third less of the system. So the amount of margin I needed and the account size I needed was a lot less. So therefore, my rate of return went up a whole bunch. So it was kind of a great way to see if you apply some tests to your system before you start trading it, what actually happens. And, you could say, well, hey, how did you still get 10 or 11 that failed? Well, It's amazing how easy it is to create systems that you think are good that just fall apart. So it could be things like you just tried too many, you had too many rules, or maybe you did your walk forward test and then you went back and retested a couple times when you shouldn't have, or your optimization was just, you did too many iterations with your optimization, or maybe the market changed. So, for example, the Euro systems I show in the book, they had some really nice performance after I developed it. And I started live trading with it. And even then, they were doing good for a while. And then what happened was the volatility in the Euro went to basically historic lows that it had never seen. So now I'm running my system with conditions that had never occurred before, that I certainly never tested. And guess what? The system started to underperform and started not to do real well. And that's a good indication. Sometimes you'll see during this waiting period that the market changes on you and your performance, it shows up that your performance doesn't do good. But I found it's much better to find that stuff out before you go live. And even if that means eliminating more systems than you would like to, I think in the long run, you're left with a better portfolio of systems.
Yeah, it definitely sounds like a beneficial step to include in the process. So if you're trading a number of systems in a portfolio and you're also monitoring others for possible inclusion, how do you decide when to add or remove systems?
Well, I guess it's 2 points. Obviously, to add them, it would be as my account equity grows. You can you can make a decision. Should I add new systems, or should maybe I increase the size on existing systems? And that's sort of more of a philosophical choice. And by that, I mean, some people like to trade a couple systems with really big size, and just get to the point where they're trading 10 or 20 or 50, whatever contracts. And if you have enough confidence in your systems, you could probably do that. I'm always looking at the opposite, though, where I'm always assuming that a system that works is probably going to break at some point. It's not going to work as well. So what I try to do is add systems. So as my account grows, I'll start thinking about, and this might be every month or every couple months, I'll think about adding systems and take a look at some of the systems I have waiting, that I'm not trading right now. And I'll take a look at them and say, okay, well, maybe now's the time. Does this fit in with all the other systems I'm trading? And if it does and the performance meets all my goals, then that would be a time I would add it in. So the adding can just be a piecemeal thing where maybe you just add a system or two every month or every couple months. And then the flip side is, what do you do with systems that underperform? And you can get real complicated with it. I know people who base it on a certain amount of drawdown. So if let's say they had a $10,000 historic drawdown, well, in live trading, if that particular strategy ever hits that, they'll quit. There's a few different ways, a lot of different ways you can do it. I mean, as many as you can think of, you can use to quit. I found the key really isn't so much the particular idea you pick, but that you actually follow it. So what you do is you do this at the beginning. Before you start trading, you say, okay, this system X, based on everything I know about it, I'm going to stop trading when it hits, say, 6 losing trades in a row, because historically it's never had more than 2. So I'm going to say, well, hey, if I hit 6 in a row, something is wrong with this system. And that's when I'm going to stop. You write it down and you put it somewhere, or maybe even share it with a significant other or a trading partner to help hold you accountable. So when it does happen, you just, you're relentless, or you're ruthless. You stop trading because it's set. You wrote down at the beginning, I'm quitting this system when this happens, and then you do it. The worst thing you can do is not to do that and then make a decision in the heat of the moment. So, and that's what most people do. And I've done it too, and I probably still do it sometimes. Uh, but you'll have a system and it'll start underperforming, and you won't have any kind of set rules for when you're quitting. And what ends up happening is you watch it day after day go down, and eventually you start getting very emotional about it. And then finally, I've had enough. I'm just going to quit it, and you stop it. And that usually ends up being the point where it turns around and starts going back up again. But you don't make good decisions when you're under stress, and having a losing trading system brings stress. So a good way I found to get around it is you come up with your rules beforehand and then just stick to it. And then it just becomes, you become a lot more professional in your approach, a lot more detached. The emotions aren't going to get to you. If the system fails, okay, well, it failed. And you're going to quit. And then you just put in a new system or just keep on trading what you've got left. So that's kind of how I approach it.
Okay, great. Thanks for sharing that, Kevin. I think we'll move on from the strategy development process to some general questions to wrap up. So,
Sure.
what skills do you think are necessary to be a good strategy developer?
Well, obviously you have to have some programming skills, and you have to also know your trading software well enough to know. I always say you have to know it well enough to know how to trick it, to create these great looking back tests. If you know the tricks to do that, you'll avoid them in your real development. You also have to have some good analysis skills where you have to know what you're looking at and what's good and what's bad. You also have to be able to follow a process. A lot of people just kind of go into strategy development, and what they'll do is what the software kind of leads you to do. You put up a chart, you create a simple strategy, or you insert a strategy, then you optimize it and run with it. Well, I mean, that's not the right process. That'll just get you to the poorhouse quickly. So you've got to really have a process and be willing to stick to it. And then probably the other big thing is discipline. You really have to have discipline. And one, you have to have it when you do go live and do it in your own live trading. I've talked to plenty of people who've created what they think is a great system, but when it comes down to it, they can't execute it consistently. They'll turn it on, they'll turn it off. They'll get scared because there's an FOMC meeting, and so they'll turn it off that day when historically they never did. So now they've just invalidated their back test basically. So you got to have the discipline to actually trade the system, but the other part of that is you really have to have the discipline to go through the process, because it's so easy to cheat and to cut corners when you're developing a system. And probably like most people, you're probably doing it on your own. Who's going to know? Nobody's going to know if you over optimize or you cheat a little bit. Well, I'll tell you what, nobody will know except the market. The market it's uncanny how the market can find out all the ways you cheated and then beat you up in real time. You really have to be disciplined to create a trading system and then to follow it in real time. So that's probably the other big key.
What's the biggest lesson that you've learned personally through trading?
Oh, that's a good question. Probably the biggest lesson is you just have to be persistent. And a lot of times what you have to focus on is the end goal, not necessarily all the in-between stuff. So what I mean by that is a lot of people will focus on the day-to-day fluctuations in their account, and that'll just drive you crazy. What you have to focus on is more the end goal. So let's just say, hey, my goal is 30% a year return or 50% or whatever. And I know I have to endure a drawdown to get there, but I'm just going to focus on that end goal and develop trading systems that support that goal. And yeah, I know I'm going to go through some bumps in the meantime, but I just have to keep looking out to the horizon to know that if I'm doing things the right way, eventually things will work out. And it might always not always be in the short run. You can certainly have huge losing days, but that doesn't mean that your whole approach is wrong. So, focus on that end point. And also then the other part which I mentioned is be persistent, where maybe the first 50 trading ideas you try, the test results are awful. Well, that doesn't mean you quit. It means you keep going until you develop something. And then once you do, the next one becomes a little bit easier. And then you just keep developing and developing. So you really have to stick to it, is the other part.
That's great advice. Thanks. Do you have a favorite trading book?
Probably the best, if I had one trading book to read, it would probably be the Market Wizards book. And that's just because it's some good interviews with a lot of different traders who do things differently. And what you'll realize by reading it is there is no perfect way or set way to trade. Some people do the exact opposite of each other and they both end up being successful. But what you will learn is kind of the mindset of what a successful trader kind of goes through and how he kind of thinks. And that's why I think that's a really good book. And it's actually a series of books, but my favorite one's the first one, which is just Market Wizards.
Yeah, those books are classics, aren't they? And finally, what's the best way for listeners to get in touch with you?
The easiest thing is probably just to visit my website. It's www.kjtradingsystems.com. You could probably also Google my name, Kevin Davey, and put trading with it. And I'm sure I'm probably towards the top of the Google rankings there. You can also feel free to send me an email, and that's kdavey@kjtradingsystems.com. If for those of you who frequent the TradeStation help forums or Big Mike Trading, it's another popular website. At both of those websites, you can find me. My nickname is Kevin K Dog, so that's my username at both those places. So it's if you do a little searching, you can definitely find me, and I'm more than happy to talk to both new traders and experienced traders, and answer simple questions you might have.
All right. So thanks so much for sharing your knowledge and experience with us today, Kevin. Is there anything else you'd like to mention before we wrap up?
No, I think we pretty much covered a lot of it, and hopefully people just get a sense of this isn't easy, and it's doable, but it's certainly not simple. And if you go into it with that mindset that, hey, it's going to take a while to learn, it's going to take a while to get good at, you'll be a lot better off. Don't be one of the people who think they can become rich overnight, because as I like to tell people, trading is the hardest way to make easy money that I know of.
That's fantastic. So I highly recommend everyone head over to Kevin's website. That was kjtradingsystems.com. It has a wealth of information for you to check out more of his work. And his book, Building Winning Algorithmic Trading Systems, is also a valuable resource for beginners and experienced developers. So I highly recommend you get a copy of that one. Thanks for your time today, Kevin.
Well, thanks for having me, Andrew.
Cheers.
I appreciate it.
How did you enjoy the chat with Kevin today? Here are my top 5 takeaways from this episode. First one, why goals and objectives are so important in trading. It was really interesting to hear how Kevin maps out his goals and objectives before he starts developing a system. This type of careful consideration really drives focus towards a specific outcome, whereas I guess the most common approach is just to test ideas until you find one that looks good enough. The second takeaway is the using the monkey test to validate entries and exits. That was the addition of randomness to test if an entry or exit has any validity. So to test an entry, he would exit at a random number of bars, with the idea being that if you can show some success with randomness in there, you may have something worthwhile to work with. The third takeaway is re-optimizing systems. So if you're using walk-forward analysis during the system development process, you should remember to re-optimize your systems with the same regularity that you completed the walk-forward optimizations. So, for instance, if your walk-forward optimizations were every year in the backtest, you should continue re-optimizing those or that strategy every year in forward testing as well, forward trading. The fourth takeaway, why you shouldn't start trading a strategy immediately after you finish testing it. I guess we've all experienced or heard about trading strategies that look great on paper but stop working as soon as you start trading them. Kevin's solution to this is not to start trading a strategy immediately after you've completed the development process, but rather to leave it alone for a while, checking it every month for 6 months or so just to see how it performs on data it hasn't seen before. Doing this may cause you to miss out on some profits, but it could also reduce the chance of trading an over-optimized system that won't work going forward. It seems to have worked nicely for Kevin, so it may be something to consider in our own trading. And my final takeaway was the importance of Monte Carlo analysis. Kevin highlighted an issue with backtest reports in that the performance results are based on a specific sequence of trades. So a backtest report could only be showing you part of the picture. He's even found some systems that look great in a backtest report, but once they've run through Monte Carlo analysis, it's identified that the strategy actually has a lot more risk than that's been shown in the backtest report. So Monte Carlo analysis is an important part of the system development process. Now onto the show notes. Don't forget to check them out for this episode. We have more details from the interview, including links to websites, books, quotes, transcripts, and bonus content. The show notes can be accessed directly by typing bettersystemtrader.com/5, because this is episode 5. Just type that into your browser and you'll jump straight to it. Also, Kevin has kindly offered a free Monte Carlo analysis tool for all Better System Trader listeners to download. I highly recommend you go to the website bettersystemtrader.com and check the article there. It's called "Are Your Backtest Results Fooling You?" It takes us through an example of Monte Carlo analysis and how your backtest reports could be understating risk by only showing part of the picture. It's an extremely interesting article, so go check it out. Download the Monte Carlo analysis tool. Oh, and one other thing before I tell you about the next week's episode. In episode 3, Cesar kindly offered to open his Amy Broker coding and backtesting course again just for Better System Trader podcast listeners. The course offer expires on the 20th of May 2015 and class numbers are limited, so if you're interested, head over to his alvarezquanttrading.com website and click on the course link, or you can find the link in the show notes for episode 3. Next week's guest has university degrees in mathematics, physics, engineering and computer science, completing graduate studies and research in modelling and simulation, statistics and some of the early work in artificial intelligence. He has over 50 years' experience in research and applications of modelling and simulation of financial systems. He has previously worked as a senior research analyst for a CTA firm and as a consultant to trading companies and individuals. He's a speaker at international conferences and is the author of 5 books on quantitative trading systems. In next week's episode, we talk about major changes occurring in the fields of trading system development, trading management, and technical analysis. We also discuss why trading is becoming increasingly difficult, what causes trading systems to experience periods of poor performance, how to identify and manage a trading system when it's out of sync with the market, and the 2 most important skills in system development. It's another great interview, so make sure you don't miss that one. Anyway, that's it for this session. I hope you enjoyed it, and thanks for listening to the Better System Trader podcast. Catch you next time. Bye.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.